Test. Are we live? I think we are live. Let's just give it a minute for people to come in before we begin. All right. While we're waiting for people to come in, let's just take a look at the markets. I think with everything that is happening in the Middle East, I would say that markets are recovering fairly well for now. I think we need to see what happens throughout the rest of the day. Let me share my screen with you. So we see today, even though the markets was down over 1% earlier on, let me see. I think although the market was down more than 1% earlier on, we're recovering fairly well. S&P is just down 0.6%, Nasdaq down 0.5%, and the Dow Jones is down around 0.9%. But I think more importantly, some of the positions that we are looking at in the portfolio, this has recovered somewhat. Amazon has somewhat recovered. I think it was down at 204, 205 earlier on in the pre-markets, and so far it was down close to 4%. So like I said, we are not too sure whether this is just a bounce at the start of the market and whether or not this will continue to be sold off. Now, later I'll explain as well what I'm planning to do with this portfolio and basically tell you what to expect from the live streams. There's 11 of us here. Right. Thank you for joining us today. It is a very volatile day to start live streaming. I think I was planning to do this live stream on the 2nd of March, a couple of weeks back, and then to try and continue this on a daily basis. And I did not expect what we actually got today. So, Dick South is asking why markets are going up. They're going to pump and dump. I think at the end of the day, you got to understand that markets do not react to news that has already happened, right? The conflict has already started. The markets do not react to news that has already happened. The market is a forward-looking mechanism. So to be very fair, the market doesn't really need the conflict to end in order for it to pump. I think what the market actually needs is certainty over where this conflict is going, how long it's going to be, how long it's going to last. Now, for me, when I take a look at the whole thing, I do feel a little bit uncertain about what to expect. So I'm just going to quickly summarize for us what I'm seeing in this US-Iran conflict. And basically, we take there, we will go into the oil prices, what to expect in the economy, and then we'll break it down into some individual companies, and then we'll end off by talking about the portfolio that I'm showing you over here and what we plan to do with this portfolio. Okay, so it's 11 of us here. I think 13 of us here right now. So I think it's good enough for let's talk a little bit about what to expect over here. And I think for me, this is a very I wouldn't. Okay, I think interesting is not the right word to use right now. Let me share my screen in case. Yeah, I think it's shared. It's just that let me zoom it in. Okay, so we already know that over the weekend, US and Israel struck Iran, basically killed off their supreme leader. And I think right now you actually see two camps of people, right? People who are uh, basically upset, they are mourning the loss of their supreme leader. And at the same time, you also see videos of people on the streets of Iran celebrating. I think we have also heard of people giving interviews. Perhaps they are Iranians, but they are not in Iran. They are in other countries where they say that a lot of their families are actually excited about this. But at the same time, they are also worried that if this military strike is basically the end of all the actions that US and Israel plans to take, then what could happen is that there is going to be, or there could possibly be a power vacuum. And so when there's a power vacuum, I think we have seen what has happened before in history. Whenever there's a power vacuum, I would think that sometimes things tend to get worse. So I just want you to listen to what the Iranian foreign minister has said over here. basically his point over here, this was just shared on the 26th of February, so just a couple of days before the attack. But his point over here is that he has seen suggestions in the US media and elsewhere about possible assassination of the leaders, but he tells us that Iran, or the system that is running Iran, doesn't depend on just one individual. So I think it does echo some of the fears that people on the ground are basically telling us as well, which is that you do not know, once you remove the leader, whether or not the conflict will actually resolve itself, and whether or not they can get someone that really wants the good for the Iranian people into power. Now, with that being said, I think while we are always trying to piece together the different pieces of the economy and the geopolitical climate that we live in, it's also important to remember that we are talking about the lives of people over here, right? The people on the ground, Iranians and the Gulf nations that are surrounding them, people's lives are being affected. People are being killed. Innocent people are being killed because of a lot of this. And I think whichever side of the fence you fall on regarding this conflict, it's important to remember that while we are talking about markets right now, that we're also talking about lives, and lives do matter in this in this whole discussion. And it's not just purely a financial discussion, but I think what we want to do as investors is to not completely cut ourselves off from the emotions of understanding what these people are suffering, but basically understand how this can also affect our portfolio. So let's take a listen to what he has to say, and then we'll carry on from here. I'll put this at 1.25. Oh, I've just been told that you guys can't hear the video. Okay, let me see what's happening here. I've just been told that you guys can't hear the video. If I play it from here, can you hear the video? All right. I think perhaps you're not able to listen to what he's saying in the video, but I think the post here summarizes it. He says that the Iranian system does not depend on individuals; it is supported by the people. So he's not worried, even if the assassination does happen, even in the middle of war, nothing collapsed, and we were able to continue our self defense. And if anything like that were to happen again, the system would handle it. There is no problem with the system. So if that is the case, then what we are seeing right now is uh really just opening the doors for the next person in line to come and take power. And if the US and Israel is not satisfied with that outcome, then perhaps this conflict could actually carry on. And I think that was the initial fears that we are seeing in the markets, which caused the initial jitter. So, like I said, we don't really need to necessarily have an end to a conflict. Of course, we do hope for an end to a conflict, but in order for the markets to recover, if you're purely talking about the markets, what the market needs is not for the conflict to end, but what the market needs is actually clarity. And the market itself is usually very good at pricing all of this in. Okay, so with that, uh, moving on, I think one of the things that we have to understand that how this affects us and our portfolio is that if this is long drawn, we are likely going to see oil above 80 barrel. Some people even suggest that it could go as high as $100 per barrel. Now, I do not know whether that is definitely going to be a possibility, but we are already at around $71 over here, and I think at the end of the day, if this is a more short-lived, I think Trump suggested that this could be over in just a couple of weeks if all things go well. Then I think it wouldn't have too big of an impact on the economy. The only concern over here, if this conflict, if this firefight ends up to be long drawn, and oil prices sustains above $80, going to even $100 per barrel for an extended period of time, that might affect the second quarter earnings of companies. So it really does depend on what is going to happen, which is again going back to the point, markets need clarity. Now, for me, if you ask me at this point in time, what is the best thing to do? Should you be buying defense stocks? Should you be buying energy stocks? I think historically, whenever you look, whenever there is a conflict in the world, whenever there's any sort of uncertainty, the best time to double down on your convictions is actually to is actually at the height of the uncertainty, at the peak of the uncertainty, which is the hardest thing to do as an investor. And I think, of course, there is one there is a school of thought that says that you need to always hedge your portfolio. That perhaps now might be a good time to go into bonds, go into gold, and things like that. It's not good to go into silver because silver is down today, surprisingly. And a lot of people talk about hedging. For me, I have hedged. I have advised certain people to hedge their portfolios a couple of weeks back, but this wasn't the reason why I told them to hedge their portfolios. I think in general, 2026 is going to be an uncertain year. That is why I advise hedging the portfolio. But especially if you're younger, if you're a young investor, you just started investing, your portfolio is relatively small, then perhaps the best thing to do is not actually to hedge your portfolio, but to find ways to save a little bit more money over these couple of months so that you can dollar cost average at an even heavier pace into the markets at the peak of the uncertainty. Because after all, this is supposed to be money that you do not need for the next 10 years or so. So, like I said, if the conflict carries on just for a couple of weeks, I think the markets will adjust to that. There shouldn't be any big issues that come up with the economy. I don't think we are going to see the second quarter earnings be affected by this. But at the same time, we also know that as oil prices rises, one of the things that could potentially happen is that we see inflation come back. Now, last week when PPI numbers were released, I think the markets got spooked by the higher than expected PPI numbers. And with the oil prices increasing, that is also basically another fuel to the fire, adding fuel to the fire of inflation. And I think people are worried that inflation might be stickier, or in the worst case scenario, inflation might come back. And so because of that, right, even though the next Fed chair is basically someone that Trump practically handpicked, there is no certainty that he's going to be able to start rate cuts in May. Now, this week, I think towards the end of the week, let me take a look at the economic calendar. I believe we are getting unemployment numbers this week as well, right? Yep. So the unemployment numbers, we're getting them on Friday this week. Right now, it's around 4.4. We are expecting it to come in at 4.3%, which actually means a drop in unemployment for people on the ground with jobs. That is a good thing. We want to see unemployment come down, but that again adds another perspective that the Federal Reserve have to consider when they discuss interest rates. If there is fears of tariffs affecting inflation, if there is fears of rising oil prices, increasing inflation, and at the same time, the unemployment rate is actually coming down, there is really no incentive for the Federal Reserve to cut interest rates in May. And because of that, we could really see interest rates stay higher for longer. And I think that is why we are seeing the markets in a risk-off environment right now. All right. So I think for me, that's what I have to say about the US and Iran conflict. I really hope it ends soon. I think if it ends soon, the effect on markets should be fairly minimal. If this is something that turns out to be long drawn, then I think we will have to pay attention to certain things like oil prices, because it affects the input costs of companies, and then how that thereafter affects inflation and what the Federal Reserve will choose to do. But I think if you consider the fact that we are in a midterms here, time is basically running out for Trump to, I think, turn the sentiment back towards the Republicans. Hopefully, he doesn't want this to be long drawn as well, so that they can really focus on the affordability issue, because that is how he has been trying to position himself and the administration going into the midterm. So really, I think it doesn't benefit Trump and the administration to be in a long drawn conflict, which is why, if I'm looking at it from that perspective of what is best for Trump and his administration, what is best is a very short conflict, and the Iranian people take over thereafter. And I think he wants to leave it at that. And if that happens, I think the markets can carry on from here. Now, the only thing I have to say about this is that over the last couple of weeks, the market structure has been rather weak. Now, I'm not someone who is deep into technical analysis, but basically, every time the S&P tries to recover, bounces off the 50-day moving average, or it's just been hovering there. And I think we are waiting for any sort of news to either have a breakup or a breakdown. So really, I think it's 50-50. I don't really, I can't really say for sure where I think this will go. I am perhaps a little bit more cautious over here, thinking that it may drop back into the 670 range. And as long as it stays above 671, 672, hopefully the S&P, this is just a minor correction and we can rebound from here. So moving on from this, I want to talk a little bit about Bitmine first, and then I will talk about the portfolio later on. So every week, what I like to do is I will look at what Bitmine posts regarding their Ethereum holdings and how that affects the valuation. Now, usually it doesn't really affect the valuation much over here. So I'm just going to show you what they post. So today is 2nd of March. Is this the latest disclosure? Right. So Bitmine announces Ethereum holdings. Okay, give me a second. Right. Yeah, so Bitmine announced Ethereum holdings reaching 4.47 million tokens, total crypto and cash holdings of $9.9 billion. So let's take a look. Now, Bitmine has staked a total of 3,040,483 Ethereum. I believe this has not changed from the previous weeks. Okay, over here, I need to key in the correct number because I was using 4.5 million as in my last valuation video. So 3,040,483. Right. And the price today, 1966. All right. Total Ethereum. Also, in a sense, I think you can say that Bitmine has started to increase slightly their pace of buying crypto. Let me take a look. 4,473,587. Okay, I'll zoom this in for you later after I fill up everything, and then we'll talk about the numbers. Okay, which means this week they purchased a total, which means this week they purchased a total of also around 51,000 ETH. So I think after Tom DeMark came on board, you can see that Bitmine has been a lot more disciplined in how they continue to accumulate Ethereum on their balance sheet. And so right now they hold about 3.7% of the total outstanding supply of Ethereum. I'm going to have to move this down because I was using this to calculate the average cost basis. In terms of the amount of cash that they are holding right now, they have, so they raised quite a bit of cash because last week we actually saw that they were trading above 1x MNEF. So I think they make use of the opportunity to raise that amount of cash. And I think one of the things to be aware about here, I think they are also doing this preemptively in case they do end up trading below 1x MNEF for an extended period of time. They would have the cash on hand to continue buying Ethereum. So over here, sorry, I should just be dragging these. So they raised a total of $177 million and purchased another 51,000 Ethereum on the balance sheet, bringing the total Ethereum on the balance sheet to 4.473 million Ethereum. Now, today, the price of Ethereum, I believe is around $1,974. So this brings the total value of their Ethereum to $8.8 billion. And then with the cash and equivalents at 868, this brings their total net asset value per share at $20.64. Of course, we do not have the latest dilution numbers over here, so it's a little bit hard for us to project out the accurate MNEF. I'll go and take a look at the numbers, and if I were to, I'll probably put a more succinct video together to talk about this, and then everything over here in terms of the rate of accumulation should be familiar if you have followed on with the videos. Again, let's just project this out not very long to 30th of June 2026. just basically the next 3 to 4 quarters, because initially we were doing until 31st of March, but that's only just about a month away. So right now, they are purchasing Ethereum at around 18,259 Ethereum per day. From now until the 30th of June, there's a total of 120 days. And if you take a 30% margin of safety, they would actually purchase a total of 1.5 million ETH. Now, I've mentioned in my previous video that I think we need to take a slightly larger margin of safety because they're actually slowing down their ETH purchase. And you can see over here, although they have ticked up slightly from 40,000 ETH to 50,000 ETH, this still works out to be around 9,000 Ethereum purchase per day. So if we take a 50% margin of safety, on the 30th of June 2026, we should expect BitMine to have around 5.5 million Ethereum on their balance sheet. And at that point in time, if Ethereum still stays in the $2,000 range, and their cash and cash equivalents basically stays more or less level to where they are today, then we should expect a projected net asset value of around $12 billion. So with $12 billion, this is their net asset value. Then you have to optimize for their staking yield. Right now, they're staking around 3 million Ethereum. I think they are going to end up staking more than that if their new Ethereum balance comes in at 5.5 million. So let's call this 4 million Ethereum by 30th of June, which puts their staking rewards at around $230 million. Again, using these same assumptions, what you're getting is that the BMNR share price should be around $27. So the reason why the share price keeps going up, I'm going to change my staking back. The reason why the BitMine share price keeps going up, or the fair value of BitMine keeps going up despite the price of Ethereum coming down, is because as the price of Ethereum comes down, BitMine is able to accumulate more and more Ethereum on the balance sheet. And by holding more Ethereum, it kind of offsets the price drop. And I think one of the things that you have to bear in mind over here is that when Tom Lee spoke about the bottom for Ethereum, one of the things he did mention is that how to tell when the bottom is in is when bad news happens and the stock, or in this case Ethereum, stops going down anymore. And I think, to me, it was quite amazing that even with the conflict that has happened over the weekend, I expected Ethereum to go down a lot more than it has done. In fact, it actually stayed pretty strong between $1,900 to $2,000. And I think that is actually bullish for Ethereum. I think that also shows us that at a certain point, the buyers are coming in, sellers are basically running out of steam in the $1,800 to $2,000 range. And I think really hats off to Sean Farrell for calling this all the way back, I think in December and January of 2026. Hi, Clap My Dog. Well, you're welcome. I'm hoping to come on live more often. We're starting with 3 times a week, and then we are hoping to move into daily going into April of this year. All right, so with this, that is how we get to a fair price of around $25, $27, depending on your staking assumptions. Earlier on, we got $27 because we changed this to 4 million ETH stake. With 4 million Ethereum stake, your fair value should be around $27. And if you assume the Ethereum being staked stays constant as where it is today, then fair value should be around $25. But Tom Lee did tell us that they are actually making up more than half of the Ethereum validated queue. So I do expect this to actually go up over time. So I think with BitMine, there's nothing much to add over here. Some of you have asked me to speak a little bit about the Jane Street incident. And I think that at the end of the day, market manipulation will always happen, which is why it's important to keep a lookout on the fundamentals. Now, I think for me, at least, when I listen to the Jane Street event, I am not so naive to think that they are the only fund or they are the only financial institutions that are doing this. I think they are the only one that has gotten caught and gotten sued so far. I do expect that there are more institutions out there doing this kind of things to manipulate the markets, which is why in the short term, you never really know who is manipulating the market and what people are trying to do. But over the long term, eventually they will basically turn their attention elsewhere And once these institutions turn their attention elsewhere, the price of some of these assets can continue to go back to its original trajectory, which is exactly what I believe will happen with Ethereum over here. Yeah, exactly. Many more, but perhaps they don't get caught. And I do agree with that. I think hopefully some of them actually do get caught, since I'm actually hoping that this Jane Street thing unravels a little bit more from here, and then we can actually see who are the financial institutions manipulating it. But I would guess that a lot of them, after Jane Street getting caught, would likely shift their attention elsewhere. And hopefully, I think that is exactly what we're seeing, because otherwise, I would expect a bigger drawdown in crypto over the weekend as well. Right. So I think the fact that crypto more or less maintains steady between, at least Ethereum more or less maintains steady between $1,800 to $2,000, shows us that a lot of the sellers are slowly, losing steam over here. And hopefully, that is a good thing for the future, especially as the markets recover. That will bring the prices of Ethereum back up. Because if you look at some of the assumptions that we are having, right, with Ethereum prices, I don't even need them to recover to, yeah, even if Ethereum prices recovers to $3,000, the fair value at least should be $34, which is pretty close to my cost basis. I believe my cost basis is around $37, $38. So even then, that would be a way better scenario already. So I think for me, I've been accumulating very, 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 very slowly in the $18 to $19 ranges. The only reason why I've been so slow is because I have a big enough position, and I do want to spread my capital elsewhere. But at the same time, I also know that these prices, uh, I think if you ask me, I do think that if the market remains stable, if there is no black swan event, anything that caused the economy to crash, $18, $19 where we are right now, all the way down to $16 in that range, that $4 range between 16 to 20, that should be the lowest that we go. But if the market corrects because of some geopolitical event, because of some economic issues, then I think we could go even further down into the low tens. But that is a big if. And the reason why I'm not is because, like I said, I expect this year to be volatile, which is why I have chosen not to dollar cost average so aggressively into all of my positions. Cost basis in the 50s. Well, I mean, I started off with my cost basis at $45 because I was willing this quite aggressively between 45 to 60. And then I got caught with $45, and then I had to, average my way down. Yeah, so I started averaging down once they got below 24. And I guess if you will that position, you can easily get your adjusted cost basis down below that, because I believe my cost basis is in the $38 range. Adjusted cost basis should be around 34, 30, 33, 34. Yep. Okay, so with that, I've covered what I need to cover for BitMine. I think everything seems to be trending in the correct direction. They are doing what we're expecting them to do. I'm actually pretty excited to see the huge capital raise. I say huge because comparatively, if you look across the last couple of weeks, sorry, I realize I'm supposed to zoom this in a little bit for you. Okay, if you take a look at this column over here, this is the amount of cash that they are supposed to be raising. And you can see since the 15th of December, their cash raises have been actually pretty slow. So in fact, there are a couple of weeks where they were dipping quite heavily into their cash position without raising capital, because Tom Lee has already promised us that he's not going to raise capital below 1 times MNAV. And in the last 2 to 3 weeks, whenever I've done my BMNR video, we have noticed that they are actually trading above 1 times MNAV, and we are seeing that in the last 3 weeks, they have raised around 250, close to $270 million. And I think this is something that is, at least as an investor, it basically soothes a little bit of my concern, because one of the concerns I've always stated for BMNR is that we are investing in BMNR because we believe that they can buy Ethereum faster than we can. And they can only do so if they preemptively raise capital should the market correct. If they wait until the market correct, then they try to raise capital, it would be too late. They would be basically stuck holding Ethereum and not being able to add, which is exactly what we could be doing ourselves as investors. So therefore, these opportunistic raises, to me, are actually a good thing if you're a long-term holder of a BMNR. Same dilemma, large position on ETH thesis, wanting to be adding below 20. I've slowed down these. Right. Right. So actually, one of the things I have actually done is to move away from BMNR and buy more Ethereum itself. Yeah. So I think to me that helps to adjust my risk a little bit, because I think BMNR is highly, highly volatile. I mean, last week we saw one day where it's up 13, 14%, and then it crashed all the way down 8% back to where it started a couple of days before. Slowed down on DCA. I'm right. So I think that's I think when this happens, when you're out of cash, you're just holding the bag. It's really going to be a while. I think every investor can relate to that sentiment. In the past, when I first started buying SoFi, I started buying in the $10, $8, $9 ranges, and then it fell all the way to $4, $5. And when it was at $4, $5, I ran out of cash. Not because I had no cash, but because I was a little bit careless, and I had a call option. I got a put option assigned to me at $15. So when SoFi was trading at $4 to $5, I ended up buying shares at $15. That's how I ran out of capital to increase my SoFi position. That was like back 2-3 years ago. So I mean, these things happen. I think as investors, we all understand that feeling. But even as Ethereum recovers, I think it really shouldn't be too far fetched that it can recover to $50 in the next maybe 2 years or so. Because all it takes, if you see what we are talking about, just for your sake. Oops, I shouldn't be doing this. When will it get back to $50? Let's say it's $4,500. Yeah. If Ethereum recovers to $4,500, okay, if Ethereum recovers to $4,500, assuming no increase in staking and under the same bearish conditions, and the reason why I say these are bearish conditions because MNAV of between 0.9 to 1.3 is actually pretty conservative. I think in a more risk-on market, the MNAV tends to expand into the mid ones, right? So 1.3, I would say the bearish case in a risk-on environment would be a 1 times MNAV. At the base case would tend to be around 1.3, and the bull case would be 1.5. So I think the whole scale moves up slightly. So I think you should see your cost basis break even when the price of Ethereum goes back to around $4,500. Could be around this range for a while with BMR. Yep, exactly, right? So for me, I was holding SoFi for 2 years. It's stuck in the $4 to $5 range, down around 30-40% of my position before it eventually recovered. But that is why it's important to pay attention to the numbers, and if the numbers are trending in the right direction, I think you can be sure that over time, the price will eventually catch up to the fundamentals. All right. So with this, I want to talk a little bit about a portfolio that I am putting together, because last year, when I started live streaming, one of the things I wanted to do is to have a public portfolio that you guys can actually track. You can actually see what I'm doing. You can understand my thought process. The only problem is that I was using my Webull account. The Webull account, I think most of you should be familiar with it. I think I've shown it a couple of times in my live streams before. That bigger account, the problem is with it is that I am paying out my parents' retirement. At the same time, I'm also drawing from it on a regular basis as my regular income. And I'm also using capital from there to pay for my renovations. So because of that, it has actually become pretty complicated to track the actual profit from there, because I'm wheeling quite aggressively, and then I'm, having a lot of funds coming in and going out. So because of that, what I've decided to do is I've taken out around $100,000 which is around 128,000 Singapore dollars, and I've put them over here. So let me share this with you. This is basically the screen that you were seeing earlier on. So there are a couple of reasons why I am deciding to do this. I think number one, when I was starting to learn how to invest, there were a lot of people out there trying to give investment advice, well-intentioned or not, I really don't know, but there are a lot of people trying to give investment advice, and a lot of people share screenshots. And I think in today's day and age, in 2026, screenshots can very easily be manipulated and edited. So I want to show you something live that you can track, and so that I can talk through some of my thought processes as well. Now, I'm going to try not to replicate my portfolio in Webull and this account. I'm using Momo over here. The only one position that I'm going to replicate is my biggest position, which is SoFi. Really, I did think of not putting SoFi into the portfolio, but really that is how much conviction I have on that company, that I think that this is the only position that I'm allowing myself to double down, which means I'm not going to be able to buy companies like SoFi, like BMNR. I'm not going to be buying HIMS. Yeah. I nearly bought Circle in the other account, but I'm thinking of just adding it over here and talking about it. So there are a couple of ways for you to keep track of this account. Of course, I'll be talking about this account on a regular basis whenever I'm live streaming. But one of the other ways for you to keep track of this account will be to take a look at my X as well as my Instagram. I think we need so you can see my X handle and my Instagram handle down below. What I'll be doing over here is to share some of my thesis and things like that. Of course, those are in written form, and then I will translate them over here on screen for you. So you can see right now in this portfolio over here, I have 3 companies on screen. I've covered 2 of them in my Instagram. So if you actually go and follow that, let me just share this with you. So if you want the information fast, you can go and follow my X and follow my Instagram, because sometimes I will be able to post some of these things even before I talk about them on stream. But by and large, you can be sure that whatever you see online on X and Instagram, eventually I'll talk about it over here. Let me just share this with you. Okay, over here. All right, so you can see Instagram handle over here, basically the same as, below my name right now, right? You can actually follow this. What I'm going to do over here is that I'll be posting snippets of the companies of their earnings, in terms of any news around these companies. So if you take a look over here, so there are a couple of things that we plan to do, which is quite interesting. So for example, if you look at this Amazon, what do you call this? Amazon Post, yes, Amazon Post over here. Goodness, losing my words. I basically broke down what are the things I liked about Amazon, why the market is panicking after its recent earnings, and then why I've decided to start a position, right? So Amazon fallen 20% from the highs of $258, currently trading around $205. So I think if you put all the pieces together, I'm basically showing you later on through this post that this doesn't really describe a business that is 20% less valuable. So if you take a look, I actually share with you key business metrics. So over here, we are looking at the remaining performance obligations, and this has skyrocketed in the past quarter, growing 40% year over year. And you can see that this growth is not a one-time thing. Since December of 2024, RPO growth rates have been steadily increasing throughout the year, because I argue that we are basically reaching the second stage of the AI build-out. In the start, a lot of people were training the brain of the AI, and right now what we are seeing is that this is moving into the second phase, where AI is coming, we are moving into AI inference, right? So to me, this is actually a very important metric to track for Amazon. Now, overall, if you take a look at their revenue, the revenue is cyclical, right? You can actually see very clear trends in Q1, 2, 3 the growth tends to be a little bit muted, but in Q4, it's always higher. So you can see this repeat every single year, and the red line shows that they're growing at a very steady 10 to 15% year over year. So 10 to 15% does not sound very interesting of a growth company, but you have to understand that they're doing over $700 billion in annual revenue. For a company doing over $700 billion in annual revenue, if they keep up this pace of growth, they're likely going to become either the first or the second $1 trillion company out there. I think Walmart is the only company that has them close on this competition basis, right? And I think one of the interesting things that you have to take note of when it comes to Amazon's earnings is that advertising and AWS is actually driving their revenue growth. And both of these businesses are actually the high margin part of the business, which will cause their net income margins to expand as well. Because I think at the start, you can see over here that in 2022, there sometimes the net income still comes in in a single digit profit margin, which is very similar to what some of the supermarkets out there are doing. But right now, you can see in just a span of 3 years, sorry, they basically grew their margins from single digit 1 to 2% all the way up to 11%. Basically, they 11x their profit margins, and I think right now, because of this, I think the market is still not realizing how to price Amazon accurately. So today, I believe Amazon is trading at a 28 times PE. This is the cheapest ever. Of course, I think if you compare it to the overall market, markets tend to trade at 29. The market right now is trading at around 29 times PE. Slightly undervalued, not the most undervalued if you compare it to the markets. But I think in the long run, if you are pricing in the revenue growth, them becoming a $1 trillion company with advertising growing, with AWS growing, with the AI side of the business growing, then at 28 times PE, I do think that there is an opportunity over here for EPS expansion as well as margin expansion. And I think last year when we were talking about one of the companies to buy, we were talking about Google, and you can see Google is in one of my posts over here. But the argument is that I think the repricing of Amazon is going to take longer than Google. I think with Google, there was a lot of artificial uh, factors that actually kept the price low, and the lawsuit was one of the reasons. And at the same time, we also had concerns over AI taking over search. Now, later on, when I explore the Google post with you, you're also going to see that that was never the case. AI was never taking over search. It was just a narrative that news outlets like to push out, and because of that, there were a lot of artificial headlines that kept Google's price depressed. As those headlines dissipated over the last year, Google's price ran from $140 to $350 in just a period of 1 year. I don't think we are expecting Amazon to double in 1 year. For me, this is going to become one of the core positions in the portfolio because I believe this is a strong compounder through to the end of the decade. So as long as Amazon doubles by 2030, I'm actually going to be happy with this investment because it's going to anchor the portfolio. And then after that, with this anchor in the portfolio, I feel a little bit more comfortable going out, picking some of the more fast growing companies. Yes, especially under $200, right? So there are a couple of things that I'm going to be going through every single day, apart from just showing you the portfolio and talking it through, because I'll be running the wheel strategy on it. So for those of you who are interested to learn the wheel strategy, something I'm going to do as well. Okay, I just realized at least BMNR is up like 10% today, and SoFi has gone from negative 4% in the pre-markets to up 0.5%. So I think people realize that, even if the Strait of Hormuz, is it Hormuz? I can't remember how to pronounce it. The Strait of Hormuz is being blocked, right? Nobody is, going to stop using SoFi for personal loans and things like that. I like I said, I don't think the market needs the conflict to resolve itself for it to recover. It just needs certainty. As long as there's certainty, I think the markets can recover. I'm not too sure whether there's any news. Are we seeing anything? I'm currently not seeing anything over here. Okay, I'll be keeping a lookout on what happened, whether there's any news that caused the market to recover. If not, we'll go back to talk about Amazon. Then I think this is the graph over here that caused people a lot of concern. If you take a look at free cash flows, which if you are the typical value investor, or if you have grown up in Singapore, you have listened to all those corny advertisements talking about free cash flow, this would look like a horrible graph to you. And this is why you should never pay for any of those investing costs, because that is only part of the story. I think free cash flow, undoubtedly, it is important. But I think what is even more important is understanding the context of the business. You have to understand that Amazon, the culture that is being set by Jeff Bezos, is one that they have always chosen to aggressively invest into the next phase of growth. I think if they started off as a bookstore and decided not to reinvest into the business, we would never have AWS as we have it today, becoming one of the drivers of the business. And I think similarly, if they are not investing into the AI, into building out their AI infrastructure, not investing into companies like Claude and Anthropic, I think they are going to be left behind. And that is exactly what we're seeing. Because I just want to point out to you, I'm not too sure. I think, let me use this. Because while people are concerned with free cash flow, because it's a very nice term and people like to, I think, use it in a way to sound as if they're trying to be very safe. On one hand, I can understand where they're coming from, but on the other hand, it's really contextual for every single company. Because if you take a look at cash from operating activities, you can see the similar trend to their revenues. They are not making less money every single year. They are making more money every single year, cash coming into their business. And the only difference with Amazon and some of the other companies out there is that they are choosing to heavily reinvest back into the business. There's been a move in gold and silver, really. Let me take a look. Okay, I mean, silver is still down 4% today. So I think although there might have been some sort of a recovery, still not much. S&P is recovering though. We are just down by 0.3%. Okay. Where was I? Oh, right. So to me, I think while it's all very nice and good talking about free cash flow, if you fixate on without understanding the business, then you miss out on opportunities. And I guess as investors, this is what you are trying to look out for, right? Things that people miss, and you actually see the opportunity in the market. So over here, I've just shown you operating cash flows from Amazon has been growing steadily over the last, however many number of years, and it's been growing in line with revenue. So they are not actually making less money, but the reason why their free cash flow is so lumpy has to do with how they have chosen, or the company culture that they have set, such that they have chosen to heavily reinvest back into the business. Now, the only thing that I have to say over here is that I think of all companies out there in the market, Amazon is one of the few companies that I would say have really proven to investors time and time again that every time they choose to reinvest into the next phase of growth of the business, they have succeeded and they have generated shareholder value over time. So I think while holding Amazon can be a very frustrating company, because especially if you take a look at their price movement, I believe over the last 4 to 5 years they have been basically flat. This goes back all the way to 2024. Oh no, because they were down here, right at $195. You are going all the way back to, where was I? Oh, not 5 years. Okay, I must have missed. Oh, at $190. Okay, so I think when people were freaking out saying that they are going all the way back to 2022, because I heard that headline, that was basically okay, $185, $190. They are back at the 2021, 2022 levels. Basically, if you held this for the last 5 years, you basically did like what? What percent is that? 4%, 5%, which is actually not super. Yeah, sorry, it's not even. It's bad. It's bad. If you heard it for the. Okay, sorry, distracted over here. But basically, I'm just looking at the charts. I think at the end of the day, you have to understand the type of company that you're holding, the characteristics of the company that you're holding. And Amazon is one of those companies where, it's not unusual to see them flat for a period of time. They were flat all the way from the pandemic all the way to 2022 before going up again. And so Amazon is one of those companies that whenever they are in this heavy capex investing cycle, their stock price tends to stay stagnant for a period of time, 2 to 3 years, but eventually when their investments pay off, the stock price will rise. And that is the characteristic of Amazon, which is why I do think that they are deep value where they are today. Can this go down together with the market? Yes, I wouldn't be surprised to see this come all the way down to $165. I am trying to buy this below $200 right now, but I am open to starting a position right now today. And I'll update the portfolio as we go along. Okay, so moving on from Amazon, I want to talk a little bit about the second position, which is SoFi. So you can see SoFi, I think for most of you who are not new to this channel, this really isn't something new to you. I really debated leaving this out of the Moomoo portfolio, but I really couldn't because I really like the opportunities in front of SoFi right now. I think the problem is that they're still being valued as a bank by the market in terms of the tangible book value, and if you take a look at their valuations, they're being valued as a bank, but as a fast-growing bank. And I think what needs to happen is for the market to really see them as a tech company. And I think that will only happen later part in 2026 as we start to see what the tech platform revenue actually looks like before we can have a better idea. But you can see even without the tech platform revenue, I've shown you on a number of occasions that their valuations will continue to, if they continue to grow at the pace that they're growing, we don't need the tech platform revenue for this to become a good investment across the next 3 to 5 years. You can see over here, member growth, this red line has been uncannily steady at around 35% across the last 1.5 years. So they have been growing members at a 35% year-over-year pace across the last probably around 6 quarters. So this is impressive because member growth, people that are coming onto SoFi's platform will end up using their products. And as time goes on, as they deepen that relationship, SoFi can cross-sell to these members without incurring additional marketing costs. Right. So from here, you can also see SoFi's revenue has been increasing steadily. The growth rates actually came down in 2024 as they were trying to de-risk their business due to the rising interest rates. But over time, we have seen this increase across the year. And right now, they're projecting minimally 35% year-over-year growth for the rest of the year, with Anthony Noto telling us that they are expecting more than 35% growth for the rest of the quarter, because if 35% year-over-year growth in Q1 is the fastest that they're growing for this year, he would be extremely disappointed. Now, with this net income, I think over here, there's nothing much to say. SoFi is a company that has just flipped into profitability. I think what is going to be even more impressive is as we plot this out across 2026, we can start to see how fast their profitability is going to ramp. Now, Anthony Noto again told us during the earnings call that they plan to grow EPS between a 38 to 42% CAGR from now until 2028. And if you project that out, you end up with around $1.20 of earnings per share in 2028. Apply a 40 to 50 times multiple, this can easily become a $50, $60 stock by then. So from where we are today, that is nearly a 4x. Okay, again, towards the end, initially I think what I'm trying to say is that, so I usually try and pick out 4 different metrics from each company, and you can actually notice that each company is different. Like we don't use cash flow to measure a bank. So in terms of SoFi, we measure it according to tangible book value or intangible book value per share. Now, the reason why I am measuring this, because a lot of people still see SoFi as a bank. Now, I disagree that they are a bank, but I do understand that they need to prove themselves before the market is willing to give them that valuation. And until then, the market is likely going to price them on tangible book value per share, which is why this is something for now we are keeping track of. Now, perhaps in future, as they become more tech driven, if their tech platform really does take off, then we might be looking at some other things like the tech platform revenue and tech platform revenue per account. Okay, so over here, capital ratios, they're at 22.9%, very healthy. Regulatory minimum, I believe, is 10.5%. So, in terms of heading into a recession, should we head into a recession? I don't really have any concerns over here. Their default rates is at 2.8%. But when SoFi models their loans, because every time banks take on loans or give out loans and they take on the debt on their balance sheet, they have to basically model out how much of these loans are likely to default. SoFi tends to model out at around 4.4 to 4.6% default rates. But right now, the default rates are coming in at 2.8%. So that means even if we enter a weaker economic conditions, even if default rates rise, there is still a little bit of room for the default rates on SoFi's balance sheet to rise without negatively affecting their profitability and revenue. And finally, with Google, I just posted this today, 4 hours ago. This is one of those companies that I have just sold off. Okay, I did I post it on here? I think, yeah, Google is one of those companies that I just sold off. If I can find the screenshot, I will show it to you. Basically, bought it at around $120, or average. My cost basis was around $120, and we sold it at I think 310 or 312 last week, right? Because we were raising capital for the Momo account, we ended up selling it around 310 or 312 last week. So with Google, like I said, this was a very easy buy for me all the way back over the last 2 to 3 years in the $120 range. That was, I think I first bought in the $110 ranges. But last year, when it dropped down to 140, that was when I doubled down. I think my cost basis is around $120. Later on, if I can find the screenshot, I'm going to show it to you. Again, RPOs are up significantly over the last couple of quarters because of the second phase of the AI build out, very similar to Amazon. Their revenue coming in, okay, very steadily. You can see this has started to rise all the way from the fears of, search is dead back in 2022 all the way up. Again, I think Google is a hugely narrative driven company, and that is why the rebound of the share price came back so quickly, because it was a lot of artificial factors that kept the stock price depressed over a period of time. But if you look at the fundamentals, in 2022, 2023, when people were saying search was dead, look at their revenue, it was still growing, right? And I think this is why it is always important to keep an eye on the numbers that really matter for each company. Right now, in this Instagram, what you're actually seeing is the summary. But when you take a look at the videos that we're doing on YouTube, we actually broke it down into each individual segment. And what we realized was that Google's search was actually growing as fast as the entire search market, which means that they are not losing market share. They are basically defending the market share that they have already gained over the years. Moving on from revenue, net income, again, profitability increasing across the years. And I think this was something that we were targeting, especially as Google Cloud start to gain traction. I think Google Cloud is the fastest growing aspect of their business. And I think this is something that I think people haven't really started to price into Google, because I think Google Cloud is running some of the biggest companies out there. They're running companies like MasterCard and Spotify, or not they're running. I think companies like MasterCard and Spotify are running their backend on Google Cloud. And I think because of that, you can expect to see these relationships deepen as the AI build up continues. And I think because of that, we are going to see margins continue to expand for Google. I'm not too sure where the expansion will end. I wouldn't be surprised, because right now they're around 32% net income margin. Hoping to see this closer to around 40% net income margin, because I believe AWS, when it is fully scaled, it's around high 30s to 40% margins as well. Okay, with free cash flow for Google, you can see that it's not as bad as Amazon, still lumpy due to reinvesting into the CapEx cycle. But at the end of the day, when you are as profitable as Google, I think the danger is not in over-investing, because if they over-invest, they can very easily choose to cut back on their investments and basically perhaps, tighten the belt for a couple of quarters, and their cash flow will return. I think the real danger for a company like Google is if you underinvest and you miss out on the next AI super cycle. So you can see over here, currently they're trading at 28.8 times PE ratio, whereas their 5-year median PE tends to be around 24.8. So on that basis, I would say that they're actually fairly valued right now, historically, based on where they tend to be trading at. They have around $126 billion of cash on hand and $46 billion of debt. So that means they can pay off all of their debt instantly tomorrow if they chose to do so. And if they do not choose to pay off their debt using the cash on hand, in terms of their free cash flow to debt, they are able to pay off their debt in 0.64 years based on the free cash flow that they're generating. So therefore, they are in a very well capitalized position. I think a lot of people right now, I think it's just a very easy headline to say that, oh, you know what, this AI bubble is like the dot-com bubble that we saw in 2000. But I think you got to realize back in 2000, people just had to put a .com at the back of their name and they will get huge valuations without generating a single dollar in revenue. And some of these companies that are in the next phase of the AI build, these companies are the biggest companies in the world with hundreds of billions of dollars of revenue. And I think the one difference over here is that, for a company like Google, for a company like Facebook, for a company like Amazon, they already have their core business generating revenue and profitability, and they're reinvesting those profitability into the AI build out. And even if the AI build out fails, even if we overbuild the AI capacity that we need, right, all it takes is for them to tighten their belt for a couple of quarters and profitability will return. And so therefore, the risk today is not as severe as the risk that we were facing back in 1999 and 2000. Right. Okay. So, yeah. So again, if you guys are interested, you can follow this, and I'll be releasing more tomorrow, and it will be one every weekday for the next 2 weeks, because I'll be covering some of the earnings that have passed, and then thereafter we'll be adding different things over here. So this is how I give you a very quick summary of the companies, and then after that, what I'm going to do is I will also show you this second sheet over here. For those who, this is this second part. So this first part where I'm talking about following the fundamentals of the company, that's on Google. That's going to be on Instagram and X. But for those of you who are interested in using your portfolio to generate income through options, I think I've used this last year as well. Let me zoom this in for you. So right now, later on, I'm going to show you so that you can verify these numbers. You can see the numbers on screen over here. We are starting off with just over. I couldn't get it to a complete 100,000 number. It'll be very hard to withdraw. That's $2.96. But basically, in terms of cash, we have $96,404.56, and then I add the 800 shares of Grab that I have at $4.49 cost basis. This brings me to a total of $100,002.96, right? So right now, you can see in terms of stocks, we have around $3,200 worth of stock. This is basically our Grab position, and our cash stands at around $96,000. Okay. So if I bring you back to, actually, this is not 100% accurate, is it? Oh, because I should be, okay. I shouldn't be doing this. My cash position needs to be 9604.56. And this reflects the actual value of the portfolio, right? It's like 99,000. Okay, so basically what we are doing over here is tracking what we have done. So I'm going to show you. Right now, we do not currently have an Amazon position. Let's say I buy 100 shares over here at $205. This would be our total position, for instance, right? On the 9th of February, about a month ago, I sold a put for 28th of Feb at $195. I sold one contract and received $2.29, which translates to $229 in premiums. Now, I've already closed this. Trade out. Basically, I let it expire worthless, so there's no extrinsic value. On the 20th of Feb, this closed total. The trade was open for a total of 19 days. Now, over here, what I have done, because in the past due to owning too many companies, looking at too many companies, I have actually missed out on how much extrinsic value there is in the options, and because of that, like I said, when SoFi was trading at $4 to $5, I got put around, I think, 800 SoFi shares at $15 when they were only trading at $4 to $5, right? So because of that, I have actually put this in. Later on, you can actually see how this works. And then at the end of it, because I closed at it expired worthless, I kept the whole $229, which represented around a 1.9% monthly yield, right? So if you basically multiply this out, you end up with around a 24% annual yield. And so that is exactly what we're going for. I'm going for anywhere between actually, I'm pretty safe when I run the wheel strategy. I go for a 1 to 2% yield. Sometimes I'm a little bit more greedy and go for a 2.5%, but usually 1 to 2%, and I'm pretty happy because if I can get a 24% return in terms of income from the portfolio, that's $24,000 in the year just by running the wheel strategy, and then on top of that, we add on the capital growth. So you can see over we received $229. If I had bought the 100 shares at $205, then once you offset off this premium, the adjusted cost basis would be $202. But again, we haven't bought this position yet. This is something I'm going to be looking to do after this this live stream, and I'll update you as we go along. Okay, so how does the extrinsic and intrinsic value work? Because every single day, there's going to be the price of the contract. So over here in this yellow box, this is the price that you receive, right, for selling the put. So let's say it's at $3. And what $3 means is that, because I can't really show this to you here. Okay, in a sense, I can. Okay, I think using this will be a more. Give me a second. Let me copy the formula because I realized the formula is missing. Give me a second. I haven't used this Excel file in so long because I was on vacation towards the end of last year. I think some of the formulas have run. So okay, let me give you an example directly from using the numbers that we have right now. So if I go into let's go into right now and just take a look at the actual options that we have on screen. Let me share my Moomoo. Okay, so today Amazon is trading at $207.95. Let's say we go out a couple days. Okay, 45 days, April 17th. Let's say we sell the $200 put over here. You are getting around $6.05. I'm not too sure whether you can see this or whether or not I can zoom in. So let's use that it's $6.40. So what this means is that, for example, today I'm going to be opening. Okay, let me copy this down. So today on the 2nd of March, 2026, I'm going to sell a put that expires on what was the date? 17th of April, 2026. Okay, the strike price will be $200, one contract, and I'll be receiving, let's say, $6.40. All right. Oh, yes. And then the status of the first one obviously is closed, which is why this is the realized premium. The status of this $640 is going to be open. Oh, okay. I really need to get better at this live streaming thing. I realize I'm not sharing my screen. Oh, I'm not sharing the correct screen. Thanks for putting up with me as I, trip my way through this. Okay, so as I get better at this, it'll be easier. But for now, again, so what we have done is that today, on the 2nd, let's say I decide to go out and sell this put 45 days out, 14th of April, 2026, strike price $200. we receive $6.40 per contract. You multiply by 100, you get $640. So over here, what you're seeing is that if the status is closed, the formula will automatically count this as the realized premiums. But as long as it's open, it is still an unrealized premiums and does not count to the adjusted cost basis. Okay. So for instance, let's say, because we know the price is at $6.40 today. Okay, there is everything here is basically extrinsic value because our strike price is $200 and the current value of Amazon is the strike price is $200. Current price of Amazon is $207. There's no intrinsic value over here. Of course, if Amazon actually falls to, let's say, $190, then you can start to see that there is an intrinsic value that is being calculated over here. So basically, the intrinsic value will be calculated based on the price of Amazon, right? Again, this will be done by the formula. This video is not here for me to explain to you what is intrinsic value, how to calculate it, but all you need to know is that if this is flashing red, it's time to take a look at the options and probably roll it out a couple of months, okay? But until then, that will probably be another video for another day. And that's how we keep a lookout for our intrinsic and extrinsic value. But for now, the intrinsic value is basically zero. Anything that is negative means that there's no intrinsic value. And basically, the entire position is made up of extrinsic value, right? So completely fine with that. This shouldn't be 0%. I need the formula. Where's my formula? Okay. So right now, the extrinsic value makes up 100% of the entire contract value. For those of you who understand options, I'm talking about. For those of you who are perhaps new to this, I will be doing videos on this to explain this later on, okay? But this is just showing you how I'm tracking this. So as long as this number, all you need to know is this number stays above 10%, we are going to leave the options. If it falls below 10%, this will start to flash red, and then that's when we'll start to look at rolling the options. So let's say we close this earlier on the 10th of April instead of 16th. That is going to be 39 days. And the closing price, we are definitely not going to be zero this time around because we're closing it earlier. So let's say we close it at $1, which means that we pay back $100. Remember, we receive $640. This means the total profit will be around $540 in realized premiums, makes up around a 2.1% monthly yield, which is more or less in our target of getting 2% yield per month. So with that, and let's say we close this, you can see everything will be calculated, which means that right now we have realized around $750 in premiums across the next 2 months. So this is if I decide to open this trade later on. Okay, and so with that, that is how we are going to keep track of the portfolio. Right now, I only have 800 Grab in the account, nothing else. Okay, and you can see in our history, let me just share the correct screen. And so right now you can see, like I said, I only have Amazon in the account. Sorry, not Amazon. I only have Grab, 800 shares of Grab at $4.49. So this was basically what I was counting earlier on. You add this $96,400 in cash, basically takes us to a total value of just over 100,000. That is our starting point. From there, we will be tracking the returns. So day one will be counted on the 2nd of March, and then we'll track thereafter. I'm going to be putting together something on Excel so that it's easier for us to track. And then you can see yesterday, this was when, last week, this was when the Amazon put options at $195 basically expired worthless. And so this happened on 28th of February. And then we basically closed out a bunch of other positions over here, including United Health and things like that, right? So we actually sold United Health at 335, right? After buying it, I believe, quite a while ago. Where did we buy United Health? Oh, we even helped Palantir. Yeah, we sold Palantir at $187. Where did we buy United Health? I can't remember. Yeah, but we bought United Health. I'll be showing you some of the. This is a very old portfolio. I think some of you have seen this portfolio before, but I don't really talk about this because this was actually a portfolio that I used to manage for my parents. So positions here tend to be relatively safe. I bought a lot of Google, United Health. They held Palantir since the $18, $19 ranges. So they did fairly well from that. And I think that's why right now we are basically restarting this portfolio. We only have 100,000 here. I'll do everything up in a spreadsheet so it's easier for you to see. But at the same time, I'll be going in to the portfolio regularly to show you the actual trades that happen and the actual options movement that we choose to do. Like I said, the aim is to document the process, to give you my thoughts over how I decide when to buy companies, when to sell companies, and to show you how I actually run the wheel strategy, such that I generate anywhere between 1 to 2% of premiums for myself every single month, because that is exactly what I do on my bigger portfolio. That's exactly how I generate cash flow for myself. The only problem is that because I tend to withdraw from that account quite regularly, it's a little bit hard to track the profit and loss. So therefore, in this account, there will be no withdrawals. There will only be top ups, but the top ups can only happen at the start of every year, which means in the first week of January of 2027 is the next time that I'm going to be able to top up cash into this account. If not, we're just going to be managing this $100,000 for the whole year. So some of you can actually follow along and try and learn some of the thought processes that I have. And so with that, I'll bring the live stream to the end, and I'll see you in the next one. It's going to be on Wednesday, same time, 10:30. Might come on slightly earlier, but don't hold me to it yet, right? Because I do need to prep a bit of stuff before then. Okay, so we are going to be starting this live stream 3 times a week, and then we are going to go into a more daily routine going into April. And so on Wednesday, expect us to start with the portfolio. I'll update you what I've done on this portfolio across the next 2 days. All right. If there are no questions, I'll bring this to a close, and I will see you on Wednesday. All right. See you guys.